You have already lost $47,000 on a bad investment. The stock is still falling. Every expert says sell. Your gut says hold, because you have already put in $47,000 in selling. Now means admitting it is gone, so you hold. And lose another $23,000, that decision to hold because of what you already spent is called the sunk cost fallacy. And researchers estimate it costs the average American investor over $50,000 in avoidable losses over their lifetime. Not from bad luck. From one specific thinking error your brain makes every single day with money, with jobs, with relationships, with every decision where you have already invested time or money. By the end of this video, you will never make this mistake the same way again. A sunk cost is any time, money, or energy you have already spent and cannot get back. The fallacy is when you let that past investment influence your future decisions, even when logic says you should stop. Economists and psychologists have studied this for decades. The most famous research comes from Arkes and Blumer at Ohio University, who in 1985 proved that people consistently make worse decisions when they have already invested in something. Their study showed that the more you have invested in something, the harder it becomes to walk away, even when walking away is the clearly correct choice. This is not stupidity. This is a deeply wired psychological trap, and it operates silently in your investments, your career, your relationships, and your daily spending every single day. Here is the experiment that proves this perfectly. Arkes and Blumer gave two groups of people basketball season tickets. Group A paid full price, $100. Group B got their tickets for free at the end of the season. Group A attended 70% more games than Group B. Same games, same seats, same team. The only difference, Group A had paid for their tickets and felt they had to use them to avoid wasting the money. This is the sunk cost fallacy in its purest form. The money was already spent. It was gone whether they went or not. But the act of having paid for it forced them to make worse decisions about their time. Now multiply this across every financial decision you make. Stocks, subscriptions, businesses, careers, and you start to see the real cost. Here is exactly how the sunk cost fallacy plays out in investing, and it is brutal. You buy a stock at $80, it drops to $40. Every signal says sell. Management is failing. Competitors are winning, analysts are downgrading, but you hold. Because selling at $40 means admitting the $40 loss is real, so you hold. And it drops to $15. You have now lost $65 per share, not $40. The original $40 loss was a sunk cost. It was gone the moment the price dropped. Your decision to hold or sell should have been based entirely on one question. If I did not already own this stock and I had $40 today, would I buy it right now? If the answer is no, sell. The money you already lost has zero relevance to that question. Zero. But almost no investor can think this way without training, because the brain treats past investment as a reason to continue, not as irrelevant history. The sunk cost fallacy does not just live in your brokerage account. It lives in your career. Studies show that the average American stays in a job they dislike for 3.2 years longer than they should, specifically because of sunk cost thinking. The reasoning sounds like this. I have already put 8 years into this company. I cannot leave now. That 8 years is gone. It is not coming back whether you stay or leave. The only question that matters is, given where you are today, with the options available today, is this the best path forward? The sunk cost answer is no, but most people cannot separate past investment from future decision, and the cost is enormous. Research from Gallup shows that disengaged employees earn on average $15,000 less per year than engaged ones across all industries. 8 years of sunk cost thinking plus lower earnings, the total career cost can exceed $120,000 in lost income alone. Sunk cost thinking is happening in your daily life right now in ways you have never noticed. You have a gym membership you have not used in 4 months. You keep paying because you already paid for the year. The year's payment is gone. It is a sunk cost. The real question is, will you use it in the next month? If the answer is no, cancel it. You are watching a terrible movie. You have already watched 45 minutes. You keep watching because you have already invested 45 minutes. Those 45 minutes are gone. You will never get them back. The question is, does the next 75 minutes of this movie give you value? If not, turn it off. You bought a car that has needed 3 major repairs in 1 year. You keep repairing it because you paid $18,000 for it. The $18,000 is gone. The question is, given what you know today, is this car worth continued investment? The sunk cost fallacy is silently stealing your time, your money, and your mental energy. One small decision at a time. The most famous sunk cost story in history is the Concorde supersonic jet. In the 1960s, the British and French governments began jointly developing the Concorde. By the mid-1970s, it was clear the project would never be commercially profitable. Airline demand was too low, operating costs were too high. Every economic analysis said stop. But both governments had already invested over $1 billion, so they kept going. By the time Concorde finally retired in 2003, the total investment exceeded $3 billion. Years of losses, years of subsidies, all because stopping meant admitting the original investment was wasted. Economists now call this the Concorde fallacy. It is the sunk cost fallacy at government scale, and the exact same thinking that made 2 governments waste $3 billion is making you hold that losing stock, stay in that draining job, and keep paying for that gym you never visit. Why does your brain fall for this every single time? It comes back to loss aversion, the same bias we covered earlier on this channel. Your brain feels losses approximately twice as painfully as equivalent gains feel good. When you walk away from a sunk cost, your brain registers it as a loss, even though the money is already gone. Even though walking away is the rational choice, your brain is trying to protect you from the psychological pain of accepting a loss. It creates a story. If I keep going, maybe I can recover what I lost. This is called escalation of commitment. The more you have invested, the more committed your brain becomes to continuing, because the alternative, accepting the loss, triggers the same pain response as an actual new loss. This is why sunk cost thinking gets worse over time, not better. The longer you are in a bad investment, the harder it is to leave. Let me show you what the sunk cost fallacy actually costs in real numbers over a lifetime. Investment losses from holding too long. Average investor loses $12,000 to $18,000 over a lifetime from sunk cost stock. Decisions alone. Career cost, staying 3.2 years. Too long in a wrong job at $15,000 annual earnings discount. $48,000 in lost income. Subscriptions and unused purchases, and average. American wastes $348 per year on services they keep because they already paid. Over 30 years, that is $10,140. Business failures, entrepreneurs who keep funding failing businesses because of sunk costs lose on average $23,000, more than those who cut losses early. Add it all up. The sunk cost fallacy costs the average American between $80,000 and $100,000 over their lifetime. Not from bad luck, not from low income, from one thinking error, refusing to accept that past money is gone. 3 fixes that actually work. Fix 1, ask the fresh start question. Every time you are about to continue an investment, ask, if I had never started this and I had this much money today, would I start it right now? If the answer is no, the sunk cost fallacy is driving your decision. Stop. Fix. 2, separate the decision from the investment. Write down the current facts about the investment with 0 mention of what you have already spent. Make the decision based only on future prospects. The moment past costs enter your analysis. You are in sunk cost territory. Fix 3. Set a pre-commitment rule before you invest. Decide in advance, if this stock drops 20%, I sell. No exceptions. If this business does not hit profitability in 12 months, I close it. Pre-commitment removes the emotional decision from the moment of pain when sunk cost thinking is at its strongest. These 3 fixes will not feel natural at first because your brain is wired to resist them, but they are the exact tools the best investors and business leaders use to protect themselves from their own psychology. The past is gone. Every dollar you have already spent, every hour you have already worked, every year you have already given back is gone. The only question that ever matters is what you do from this moment forward. Sunk costs are not a reason to continue. They are a reason to evaluate clearly, without the weight of what you cannot recover. The investors, entrepreneurs, and professionals who understand this make better decisions, lose less money, and move forward faster than everyone else. Subscribe to The Money Mind for more psychology of money every week. And drop in the comments, what is one sunk cost you are holding on to right now?